While writing about M&A for boards of directors, can you share some concerns and challenges about these transactions?
If you look at boards of directors and managers, you might say, who does what? Interestingly, state law is very clear on that. Only directors can sell the entire company. Only directors. Manager, they can't delegate that decision to management. They can delegate a lot of things to management, product development and so forth. They can't delegate that. So that's squarely on the board. The board is responsible for any decision to sell an entire company. Okay. Therefore, when a board of directors votes to sell a company to another company, they are responsible for that sale. Now, if they do it incorrectly, you'd think, well, they could be sued. They did not fulfill their responsibility and obligation very well. But there's something called the business judgment rule that says that as long as they take the care to understand the transaction and take the time to be very careful about it, and they have no conflicts of interest, and nobody's pockets are getting lined from the transaction, they'll be fine. They don't have to have a success. Even if the stock price goes way down, if they did their homework, they will hold their heads high under the business judgment rule, and they can't be sued. Well, the trouble is, shareholders will sue anyway. If they lose a lot of money on a deal, they will sue that selling board of directors. All of them, individually. They will sue the advisors and so forth. And you think, well, the business judgment rule will protect them. Have no fear. Sometimes, though, the board is a little bit lacks confidence that it really can show on the record that it showed due diligence and that it had absolutely no conflicts of interest and certainly no failure of the duty of care. They might settle. And I was just rereading that old book there, The Art of M&A Integration, second edition from around 2006, and looking back, okay, Time Warner shareholders successfully settled with the parent company of AOL Time Warner after their share price lost 75% of value. They settled and they got maybe $2.6 billion, just paid like, okay, we'll pay you. We're sorry. So that's the big concern that directors have. Not only do they, of course, want a merger to succeed, but if it doesn't succeed, they have some risk of liability in terms of the board gets sued. Now, whether it's personal liability to directors, that's very rare, but still it's reputational liability that they care about.